In this video, we are learning how to build an investment plan for your future so one day you can be living large like old Benjamin down there. For most people, wealth is built over a long period of time. You can see some influencers online that are 21 or 22 making millions of dollars, but that is very rare. For most people, wealth is going to be built over the long period, and that's why the baby boomer generation is the richest on earth, because they've had so much time to build up wealth. So before you do start investing though, first, everybody should have a baseline savings or an emergency fund built up. And this is just money that you need in the short term to cover basic needs and expenses, plus some extra money on top of that in case of emergency. And this also would be like most people's regular savings or checking account. So just money that you have easy access to for basic needs in the short term, and if something were to come up that you need a little bit more money for an emergency, that you can easily have access to that. But this would be a non-interest gaining account. Again, it's just there for easy access to your money. But once your emergency fund reaches a level you are comfortable with, what a lot of people do is they keep just adding to it even though they have plenty in there. Once you have a level you're comfortable with, what you should do is start putting money into interest gaining investment accounts. And this is where we're going to come up with your long-term investing goals, and you're going to answer 4 questions here. So the first is, what asset classes will you invest in? Are you going to go with safer, guaranteed more returns like high yield savings accounts but are on a lower interest rate, stuff like government bonds and treasury bonds? Or you could go with index market funds like the S&P 500, also known as ticker SPY, or the NASDAQ 100, also known as the QQQ account, which those just buy general market funds, so it just buys the market funds for you. You could get into then a little bit riskier strategies where you're buying specific stocks like Amazon, McDonald's, Meta, and there's thousands of actual regular stocks that you can buy out there. You can also start investing into cryptocurrencies like Bitcoin, Ethereum, Solana, and again, there's hundreds of cryptocurrencies out there. Those are just 3 of the most popular ones. Or you can get into real estate investing, and real estate investing is a little bit different than these other asset classes because you're not looking for a targeted rate of return on your interest. You're more looking to generate monthly cash flow, and you also need a lot more money up front for real estate investing, unless you go into it with a group. But either way, real estate investing is just quite a bit different than these other groups, so we haven't covered that as much in detail, but I'll go over it a little bit in this video. But regardless, what most people do is they pick a few different categories. So let's say you're going to put some into a high yield savings account. You're going to buy some general market index funds. You're going to buy maybe a few specific stocks that you have confidence in for the future, and you might throw a little bit of money into some cryptocurrencies as well. But the idea is you know exactly what asset classes you're investing in. Second question you're going to ask is, how much per month or year do you plan on investing? And it's good to stay consistent with this because consistency is what builds the compound interest. So you could say, I plan on investing $300 per month total into the various investment categories I selected. So again, you're going to take $300 per month and you're going to throw a little bit of that $300 into each of those asset classes. One thing to note here again is that real estate investing is a little bit different because what you do is, instead of doing a bunch per month to do it, is you actually put a big investment up front and then you generate cash flow later off that. So it's not like you're putting $300 a month into it as much as you are putting one big investment up front and then hoping to generate cash flow later. So it's a little different than the other classes. So the third question you're going to ask is, what is your targeted average rate of return per year? And this is pretty simple. Again, like let's say you have combo of safer returns that are 4% and then some stocks or index funds that you're hoping for 10%. So always a good average goal, and this is what most financial advisors and financial investors target, is about 7% year over year on your long-term investment accounts. That's the targeted average most look for. And again, another note about real estate is it is a little bit different than regular investing because you're targeting monthly cash flow and not an interest rate return. So once you have those 3 things figured out, you're just going to plug into the compound interest calculator and you're going to see what your account will look like in 10 years, 20 years, and 30 years. And we're going to do this in NerdWallet's compound interest calculator. And again, keep in mind this graph right here where the blue would be the consistent amount invested each year. The red would be that extra interest that's gained. The yellow line would be if you perfectly followed that targeted rate each year. So if you got 6% instead of having 8% one year and 4% the other, you would just get 6 each year. That's what that would look like. But because the real world markets are choppy and they fluctuate, your actual account value would look like this pink line where some years it's above, some years it's below, but over time it will be close to that targeted line. So let's jump into NerdWallet and get all this figured out. All right, so I'm in NerdWallet's compound interest calculator, and what we're going to do is we're going to make that financial plan and see what our account values are at after a 30-year period. So whatever you decide for yourself, I'm going to go with the example I use in the video. For your initial deposit, assume you start off with nothing in this account. It's like you're just starting it. So whatever you put your monthly contribution amount to be, use that here. So I did, in our example, $300 per month. And I'm going to stay with that. So the idea is I'm just going to keep investing $300 a month into this account for 30 years. And we're going to see what this is at the end of that. So we're going to do contribution amount, monthly, years of growth. We're going to go 30. We're measuring this after 30 years. And I'm going to go with my estimated rate of return. Before I do this, when you're doing investing, you want to do this annually. These calculations are always made annually. You're targeting an annual interest rate, not a monthly. So estimated rate of return, I said a good target. You can use a little more or a little less than this if you want to go with a safer account, because the higher you go for your estimated rate of return, the riskier it becomes. But again, a good rate, I'm going to say that most financial advisors and professional investors look for per year is 7%. So if I am depositing $300 a month for a 30-year period, getting a 7% return, what do my account values look at in 30 years? So in 10 years, which would be 2034, the account value is at $51,900, and I have $36,000 principal invested, $15,600 interest gained. In 20 years, which would be 2044, the account value is at $153,000, and there's $72,300 principal invested, and we've gained $81,000 in interest. So the interest is more than the amount invested by 20 years. And then at the end, in 30 years, 2054, our account value is at $353,000 and $108,000 invested. Total interest gain, we've gained $244,819 of interest. And again, this would not be an exact account value. This would be what your targeted value would be. So if you did stay with a regimented plan like this, your account would be very close to this amount, give or take a little bit more or a little bit less, as in that example in the video with the pink line. So you can mess around with this a little bit before you come up with an actual plan. And if you want to go for more years of growth, you can do that as well. But for this assignment, you only have to do 30. So just mess around, and that is what you're doing for an assignment. And again, you're going to let me know what the account's at 10 years, 20 years, and 30 years. And if you want to add 40, you can go for 40. Have a nice rest of your day.